is talking about silver right now. Shops are buzzing, prices look unstoppable, and your WhatsApp groups are full of charts. But here's something most people miss. The price you see for silver ETF can be different from the value of the silver it actually represents. Sometimes higher, a premium, sometimes lower, a discount. Today, let's make this super simple and practical so you don't overpay just because the crowd is excited. Imagine you're buying a movie ticket on a festival weekend. The theatre price is 200 rupees, but resale platforms show 240 rupees because demand is crazy. You're paying 40 rupees extra for the convenience and the hype. That extra 40 rupees is like the premium. Silver ETFs can behave the same way when demand spikes. So now, there are two quick definitions in plain English, which is NAV, net asset value, is the fair value of all the silver the fund holds, divided by the number of units. Market price is the what people are actually paying for the ETF on the exchange right now. If market price is greater than NAV, that's a premium. If market price is less than NAV, that's a discount. Let's put numbers so it clicks. Say the ETF's NAV is 100 rupees. On the exchange, the last traded price is 105 rupees. So the premium is 105 minus 100 divided by 100, which is 5%. You're paying 5 rupees extra per 100 rupees of true value. Flip it. NAV is 100 rupees, but the ETF is trading at 97 rupees. Discount is 97 minus 100 divided by 100, which is minus 3%. You're buying 100 rupees of silver exposure for 97 rupees, but that discount can close later. Both upward and downward moves can surprise you. Why does this premium or discount happen? Here are three big reasons. Demand and supply on the exchange. When everyone rushes to buy, bids push the market's price above NAV. When a lot of people sell together, the price can slip below NAV. Liquidity and spreads. If there aren't enough buyers or sellers at every price level, the bid-ask spread widens and you end up paying above fair value just to get your order filled or selling below fair value to exit quickly. Creation or redemption mechanics. ETFs rely on specialized players who create or redeem large units by delivering silver or taking it to keep price near NAV. On volatile days or during logistical constraints, this process isn't instant, so premiums or discounts can stretch temporarily. Here's a quick everyday analogy. Think of NAV as the MRP on the packet and the exchange price as what the nearby store is quoting during a rush. Most days, the store stays close to the MRP, but during a rush, prices can drift. So, what does a smart investor actually do with this information? Step 1. Always check the premium or discount before you buy, which is market price minus NAV divided by NAV into 100. If the ETF is 105 rupees and the NAV is 100 rupees, that's a plus 5% premium. Ask yourself, am I okay paying 5% above the fair value just to buy today? Step 2. Look at the live depth and the bid-ask spread. If the best buyer is at 104.8 rupees and the best seller is at 105.4 rupees, the spread is 60 paise. Wider spreads equals higher chance you overpay or undersell. Step 3. Use limit orders, not market orders. A market order during a rush can get filled well above what you expected. With a limit order, you set your maximum buy price or minimum sell price and avoid nasty slippage. Step 4. Check recent premium or discount behavior. If the ETF has been swinging between plus 3% and plus 6% all week because of crowded demand, you might choose to wait for calmer conditions or place a disciplined limit price near NAV. Step 5. Match your time horizon. If you're a trader trying to capture a short move, a 3 to 5% premium can eat your entire trade. If you're a long-term allocator, short-term premiums still matter, but they matter less than things like cost tracking and your asset mix. Step 6. Don't ignore costs. ETFs charge an expense ratio and there's also brokerage taxes and the bid-ask spread. Add them up. The all-in cost affects your net returns far more than you think. Let's bring this alive with three mini scenarios. Scenario A. Festival rush. Everyone wants silver exposure. NAV is 100 rupees, but buyers are lining up at 104 to 106 rupees. You place a market order and get filled at 106 rupees. You have paid a 6% premium. If demand cools tomorrow and premium drops to 1%, your price can fall to approximately 101 rupees. Even if silver itself didn't move, you will feel like silver fell, but actually the premium just normalized. Scenario B. Panic exit. Global news hits. People rush to sell ETF units. NAV is 100 rupees, but trades print at 98 rupees. You sell at a 2% discount. If you had used a limit order close to NAV or waited for liquidity to return, you might have saved that 2%. Scenario C. Calm day, smart execution. NAV is 100 rupees. Spread is tight. You place a limit buy at 100.2 rupees. Get filled and your premium is just 0.2%. Over years, that discipline compounds into meaningfully better outcomes. Here are a few nuances pro-swatch that you can copy. Intraday indicative NAV. Many fund houses or exchanges display an estimate of real-time NAV. If the ETF price drifts too far from INAV, consider waiting or using a tighter limit. Liquidity of both the ETF and the underlying. In stressed markets, if underlying silver delivery or pricing windows are tight, creation or redemption can lag and gaps widen. Tracking difference versus tracking error. Tracking difference is the long-term gap between ETF returns and benchmark returns, largely fees plus costs. Tracking error is the volatility of that gap. Lower is usually better for long-term investors. Order slicing. If you're buying a larger amount, break it into smaller limit orders and let it fill as liquidity appears across the day. Let's see some common myths busted quickly. Premium means ETF is bad. Not true. Premium or discount is a market microstructure reality. It tells you about timing and liquidity, not morality. Discount is always a bargain. Careful, a discount can exist for a reason. Low liquidity, wide spreads, or temporary dislocation that may or may not close soon. Market order is fine, it's just 50 pice. In a thin order book, one careless market order can cost you far more than 50 pice. So if you are comparing Silver ETF with physical or digital silver, remember, ETF gives exchange liquidity, demat convenience, and transparent costs. But you face market microstructure, spreads, premiums, or discounts. Physical silver has making, assay, storage costs, and liquidity hassles. Digital products depend on issuer credibility and exit mechanics. So, choose based on your horizon, cost sensitivity, and how comfortably you can execute without chasing the price. Before we wrap up, a quick compliance and friendly pointers to keep you safe. This is educational information, not investment advice or a recommendation to buy or sell any security. Markets are risky. Past performance doesn't guarantee future results. Premiums and discounts can change quickly. So read the scheme information document, key information memorandum, and risk factors from official sources before investing. Mutual fund or ETF investments are subject to market risk. Read all scheme-related documents carefully. Avoid promissory language like guaranteed, show short, safe returns, or best product. Stick to facts, show calculations, and disclose risks. If you remember only one thing from this video, remember this: always check the difference between what you are paying, which is market price, and what you're getting, which is NAV. A small calculation before you click buy can save you from paying for hype instead of value, and that's how you stay calm when everyone else is chasing the shine, by understanding what is behind the sparkle and executing with discipline. To see more videos like this, subscribe to Tradejini YouTube channel. If you like this video, hit the like button and share it with your friends who are investing in silver.